With us is Harrison Johnson, CFP with Wilsey Asset Management. And Harrison, talk about the conflict of interest around universal life. And I said when we came out of the break, or going into the break, why aren't we talking about universal life? But it's a conflict. You're saying people are not really, they think that they got something when they really don't or something.
Yeah. So, and this again deals specifically with universal life insurance. So there's different types of life insurance: term, universal, whole life. A lot of people kind of think of universal life insurance as a hybrid between term and whole life. And one of the things that differentiates it from the other two is it has a flexible premium. So what that means is the policyholder can really pay whatever they want to into the policy. Now, universal life and all life insurance has costs baked into it. So there's policy fees, administrative fees, different types of fees in there, and then there's the cost of insurance. So no matter what you pay in form of a premium, there's always this cost, but if you pay a premium that's more than what that cost is, that excess gets put into cash value, and then that can grow over time. And so where the conflict of interest arises is when an advisor sells a policy, they say, well, it's got cash growth, tax deferred growth. If the cash value grows large enough, then you can borrow against it. That borrowing is considered a loan, so it's tax-free. It can be a form of tax-free income, essentially. So it has these potential benefits along with it. But the issue is when a policy is sold, whoever sells it earns a commission. The commission is based on what's called a target premium, which is essentially a low-level premium necessary to keep the policy in force. So the advisor is not incentivized to make sure that the policy owner funds it properly. They are incentivized just to sell it. So what I see a lot is on the back end, somebody has one of these policies and they say, oh, it's got money in it. It's been growing. It should be, I'm almost going to retire soon, so it should be able to start producing income. And I'll look at it and there's no money in it. There's no cash value. And that's because they weren't funding it properly over time, because the advisor sold it to them, earned their commission, and didn't tell them how much they really needed to be putting in there in order for it to produce the results that they were expecting.
How do people get confused? Because you said that there's a person that you had to tell them they thought they had a lot of money in it, and you looked at it no, there's nothing here. How do they get confused where they think they have something when they really don't?
Well, with life insurance, you always have a death benefit, right? And so you might have a death benefit of $100,000. So I had an example of this where there was a $100,000 death benefit. This person had bought this policy, 20 years past, and they thought that this was $100,000 because it was a universal life insurance policy and the cash value is supposed to grow. So they thought they had $100,000.
So they thought the death benefit was the cash value. So that was just
they didn't fully understand it.
Yeah,
So they didn't really differentiate between death benefit and cash value, but they just remember what they were told when they bought the policy, that if you put money into this, you'll be able to use it as a form of retirement income. And so when they would look at their statements over time, they just see this, $100,000. They don't really know what a death benefit is or a cash value or anything else. So they, for decades thought that this would eventually, be $100,000 that they could use. And then I had to tell them there's actually no money in it. So if you die, $100,000 goes to the beneficiary. But
so it sounds like they bought an expensive term policy.
I was just talking to Chase about that in the break, because what happens is, let's say you buy a universal life insurance policy and it's $100 a month, just making up a number. Well, in order for it to build cash value, maybe you need to put in $500 a month so that extra can accumulate. But if you're only putting in that 100, which is the target premium, it never really builds cash value. And so now you have this death benefit when you could have just bought a term policy for maybe $25 a month to get the same death benefit. So you're exactly right. If you're not funding it correctly, it's basically a very expensive term policy, and a lot of people aren't aware of that until they try to use it and there's nothing in there.
A couple of thoughts here. I mean, the problem with annuities, life insurance, they're contracts. They're not investments. They're contracts. And you have to understand how the contract works. You add in all these layers of complexities that people don't understand. And it's like, oh, yeah, I have 100,000. It's like, that's your death benefit. Well, what's that? It adds these different layers that people don't understand. And, it's interesting, kind of within a pretty short time period, I was also talking to another new client, and she's like, oh, no, I have this life insurance policy. It's great. They told me that, when I put the money in, after 10 years, if I didn't need the life insurance, I can get my money back. Same thing. I looked at it. No, there's no cash value in it. So if you want your money back, there's no way to get it. I mean, you can stop paying the life insurance, but now that's uninsured and you just wasted 10 years of premium payments.
That's another one that, we were looking at.
It's a sales tactic of people telling somebody that something that's not necessarily false, but it has to be done properly. And the other qualm I have with this is I'm not saying that overfunding the life insurance is a good idea.
Right.
But the problem here is people aren't buying what they think they're buying.
And that's where the conflict of interest arises. So again, if, the target premium's $100 a month, if you're actually supposed to put in $500 a month to get all those extra benefits that, come along with it, with the cash value accumulation and everything else, but the advisor who sells this, whether that policyholder pays in 100 or 500 or something else, they essentially earn the same commission. So, they will say, well, if I sell a term policy, premium's only $25. I'm not going to make much money. This universal life insurance policy has all these extra benefits. It's more flexible and it's not quite as expensive as whole life. So go ahead and buy this one, and it can be a retirement income stream. But after I sell it to you, I don't really care what you do with it because I earn my commission, then I can go sell another one to someone else. So that's where the conflict of interest arises. And Chase, you're right. Even if it's funded as efficiently as it possibly can be, I still don't think it's a good investment compared to other alternatives out there, like actually investing money. But I hate to see, when I have someone who's getting ready to retire and they think they have a source of income here that is actually not there.
Yeah. I'll tell you what you do instead of a universal life policy. Term insurance, as we said, cheap term insurance. And then if you don't need the term insurance anymore, you drop it. And then max out your 401ks and your IRAs.
Yeah.
That's it. That is far better than doing this.
Wait a minute.
Universal life
Don't
policy.
you get a tax deduction for doing that too? What you don't get for insurance?
Well, people sell it as it grows tax-free. Great. So do Roth IRAs.
So do Roth IRAs,
way
exactly.
better.
Premiums that you pay into life insurance are made with after-tax dollars, and then the death benefit, or if you borrow against it, that's a tax-free. But that's just like a Roth. So there's always going to be a more efficient investment account, whether it's a traditional IRA, Roth IRA. Even I would put money into a taxable non-retirement account before I would buy permanent life insurance of any kind. So there's always going to be a better alternative. But, if you have $100 a month to put it into an investment account versus $100 a month to put into an insurance policy, the commission that comes with that insurance policy is much, 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 much more than what an advisor can earn by, having an account that you're putting in $100 a month into.
And I know we got to wrap this up real quick, but I'm guessing here, but I think the experience of the average life insurance agent is very low because there are young people that get in there. They don't know what they're doing, and then they're there. Maybe that's
another thing that I had talked about that's part of the newsletter. There are advisors out there who sell life insurance that might structure them correctly, but because that field is so easy to enter, you don't need a lot of education. You don't need a lot of experience. There's not a lot of testing that goes into it. It's very easy to enter, and so that can attract all kinds of bad actors who, can get into that just because they want to sell things and make money.
And they may not be bad actors intentionally, but they just don't know what they're doing.
They might not be aware of it. Yeah.
Might not be aware of it. And somebody told them to do that, like, oh, okay, that's great, and then they do it like, oh, I burned people, didn't know it.
Right.
So
exactly.
It's a shame. So, well, Harrison, thank you very much. We appreciate it.
Thanks, guys.
Again, that's Harrison Johnson. He is a CFP. He's with our financial planner at Wilsey Asset Management. If you want to talk to him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. You can have a free consultation with him as well. Or go to the website, smartinvesting2000.com. You can send an email right there. You'll see his email address there. Again, smartinvesting2000.com.